Imagine paying premiums for 30 years, only to have your $500,000 life insurance policy suddenly collapse and pay your family nothing. This is the terrifying reality of universal life insurance. It's pitched as the flexible policy that lets you adjust your premiums, but that flexibility hides a time bomb that has ruined thousands of retirements. We're ripping up the sales script to expose the rising cost of insurance that silently drains your cash value. If you own a UL policy, you must watch this to find out how to check if your policy is on the verge of implosion. If you're buying one, this video is the only defense against the single riskiest part of the contract. Let's start with the fundamental question. What is universal life insurance? At its core, universal, or UL, is a type of permanent life insurance. Like whole life, it is designed to last your entire lifetime, and it includes a cash value component. But that's where the similarities end. Universal life is often called flexible premium permanent life insurance. Think of it not as a rigid contract, but as a flexible financial bucket with three key components. The first component is the death benefit. This is the amount that will be paid to your beneficiaries when you pass away. The second component is the cash value account. This is a savings element that grows over time based on an interest rate. The third component, and this is the most important, is the cost of insurance. This is the monthly fee for the pure life insurance protection, which includes the risk of your death, plus the insurance company's administrative fees. Here is the crucial mechanic that makes UL unique. Your premium payment is not fixed like in whole life. Instead, when you make a payment, it goes into your cash value account. Then, every month, the insurance company automatically withdraws the cost of insurance and administrative fees from your cash value. Whatever money is left inside the cash value account earns interest. This structure creates the famous flexibility of universal life. You often have the ability to do two things. First, you can adjust your premium payments. In a good financial year, you might pay more into the policy than required. In a tight year, you might just pay the minimum amount needed to keep the policy alive, as long as there is enough cash value to cover the monthly costs. Second, you can often adjust your death benefit up or down within certain limits as your needs change. Now, let's talk about how the cash value grows, because this is where the major types of universal life diverge. There are three main varieties, and confusing them can be a costly mistake. The first and most straightforward type is fixed rate or traditional universal life. In this policy, your cash value earns interest at a rate set by the insurance company. This rate is usually tied to a financial index and can change over time, but it will typically have a minimum guaranteed floor, like 2% or 3%. Your growth is stable and predictable, but it may not keep up with inflation. The second and most common type you'll see today is indexed universal life, or IUL. Here is where things get more complex. With an IUL, your cash value's growth is tied to the performance of a stock market index, like the S&P 500. You do not directly own stocks. Instead, the insurance company uses a formula to credit interest to your account based on how that index performs. However, there are major caveats. Your gains are typically capped by a participation rate or a cap. If the index goes up 15%, your account might only be credited 10%. But you also have a floor, usually 0%. This means if the market crashes, your cash value doesn't lose value. It just earns 0% for that period. The trade-off is that you give up unlimited upside potential for protection from market losses. The third type is variable universal life, or VUL. This is the most investment-oriented version. With a VUL, you can direct your cash value into sub-accounts, which are essentially mutual funds. Your cash value has the potential for higher growth, but it also carries direct market risk. If your chosen investments perform poorly, your cash value can actually decrease, which could jeopardize the policy itself. This leads us to the single most critical risk with any universal life policy: the reliance on interest rates and the cost of insurance. Universal life policies were born in the 1980s, a time of very high interest rates. The illustrations shown to buyers projected that high growth would continue forever, meaning premiums could be low and cash value would soar. But for decades now, we have been in a low interest rate environment. Many policies have not earned the interest that was originally projected. At the same time, the cost of insurance, the monthly fee being withdrawn from your cash value, is not fixed. As you get older, this cost increases every year. In your 40s, it's a small fee. In your 80s, it becomes very expensive. This creates a perfect storm. If your cash value is not growing as fast as projected due to low interest rates, and the cost of insurance is rising every year, your cash value can begin to shrink. If your cash value ever drops to zero, the policy will lapse and your coverage will end. You will get nothing. This is the nightmare scenario that has affected many older policyholders. So, who is universal life insurance actually for? It is a specialized tool that can be a good fit for a specific type of person. It may be worth considering if you are a high-income earner with a fluctuating income who needs permanent coverage and has already maximized other tax advantage accounts. It can also be useful for complex estate planning needs, where flexibility is key. However, you should probably avoid universal life insurance if you're looking for a simple, set-it-and-forget-it policy. The need to potentially monitor and adjust premium payments over decades adds a layer of complexity that many people do not want. If your primary goal is affordable income replacement for your family during your working years, a simple term life policy is almost always the better, safer, and more cost-effective choice. In essence, universal life insurance offers a powerful combination of lifelong protection and financial flexibility. But that flexibility comes with the burden of active management and exposure to interest rate risk. It is not a product to be bought lightly. It requires a deep understanding of the mechanics and a long-term commitment to funding it properly. Before you buy, ask yourself, am I financially sophisticated enough to manage this policy for the next 30 years? And do I have a permanent need that justifies its costs and complexity? Your answer to those questions will tell you if this flexible policy is your financial friend or a potential foe.